Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. We've got a packed stack of sources in front of us today. Articles from Yahoo Finance, CNBC, Bloomberg, and MarketWatch. And boy, is there a lot bubbling up this morning.
It certainly feels like a complex brew. It's June 16th, 2025, and markets are really, digesting a messy mix of economic signals, policy decisions, and some genuinely concerning geopolitical developments that unfolded over the weekend.
Absolutely. Our mission in this deep dive is to, well, try and cut through the noise, extract the essential nuggets from these sources, and figure out what's really driving the markets and what it all means for you.
Sounds like a plan. Where should we start?
Let's zero in on the Federal Reserve's position first. It feels increasingly complicated by the swirling uncertainty around tariffs. Then we'll grapple with how markets are reacting to escalating tensions in the Middle East, take a quick spin around global markets, and maybe touch on some specific policy shifts like tax news in the UK and the US, plus the latest twist in the crypto world.
It's definitely a Monday that requires looking at multiple pieces of the puzzle simultaneously. A lot going on.
Okay, let's unpack this, starting with the Fed and the U.S. economy, specifically under the rather large shadow of tariffs. We saw some fresh economic data come out last week, right?
We did. And on the surface, looking at the Yahoo Finance article titled, "It Makes Sense to Be on Hold," some of it seemed pretty encouraging.
Yeah, what stood out?
Well, the data presented in that piece did offer some positives. We saw inflation showing, more signs of moderation, which is obviously key for the Fed.
Right, always watching inflation.
And consumer sentiment actually rebounded for the first time this year. A little lift in mood, maybe.
Okay, that's interesting. And the job market.
The labor market overall is described as broadly stable, with the unemployment rate holding steady at 4.2%. So still pretty solid on that front.
So if you just looked at that data, you might think, okay, maybe rate cuts are on the horizon. But that's not the message we're getting, is it?
No, not really. The core message from the strategists quoted across these sources, particularly that Yahoo Finance piece, is a resounding not so fast. Wall Street isn't expecting the Fed to ease up anytime soon.
They think the Fed remains firmly on hold.
Exactly. And the major factor injecting that caution, more than the data itself, it seems, is the intense uncertainty created by President Trump's tariffs. Remember those announced on Liberation Day back in April?
Oh yeah, I remember the reaction. That sent jitters through markets and supply chains for sure.
It really did.
So what's the current state of play with those tariffs now, according to the Yahoo Finance article? Are they all fully in effect?
Not entirely. Many of the initially proposed reciprocal tariffs were paused. However, the baseline 10% duties on most countries are still in place.
Okay.
And the president is expected to formally notify individual trading partners of the specific unilateral tariff rates they'll face in the coming weeks. So that shoe, for many, hasn't fully dropped yet.
That looming notification sounds like a major source of anxiety for businesses.
It absolutely is. And remember, there are still specific existing tariffs in place that weren't part of the April announcements, like those on certain fentanyl-related substances from Mexico and Canada, and the long-standing industry-specific tariffs on steel, aluminum, and autos. Those haven't gone away.
Right. And just to put a number on the impact, I saw a note in the Yahoo Finance article mentioning outside analysts. Was it Yale?
Yeah, the budget lab at Yale, they calculated the effective tariff rate on China right now is sitting around 33%.
33%. That's a hefty tax on goods.
It absolutely is, and it really underscores the potential impact. This whole situation is directly complicating the Federal Reserve's thinking.
How so?
While Cleveland Fed President Loretta Mester is quoted saying in the Yahoo Finance piece, the Fed needs clarity, not just on the magnitude and breadth of the tariffs.
Right, how big and how wide.
But crucially, their effect on inflation and what effect the tariffs and other policies will have on growth and employment. She highlighted that uncertainty as a key policy challenge.
So it really sounds like the Fed is basically stuck in a holding pattern, just waiting for the dust to settle on this trade front before making any big moves.
That's precisely the takeaway from MarketWatch and the strategists in the Yahoo Finance piece. If you look at market expectations using CME Fed projections, that's the futures data, the likelihood of a September rate cut is now priced in at nearly 70%. It's actually up from about 60% just a week ago.
So the market's leaning more towards September. What about July?
There's still about a 20% chance priced in for July, but honestly, for the upcoming meeting this week, the market is almost fully anticipating the Fed will just hold rates steady. No surprises expected there.
And the strategists seemed to back that up. I think it was Brent Schitt in the Yahoo Finance article who was pretty blunt about it.
Yeah, he basically said any rate cuts before September would likely need significant labor market deterioration, something really breaking in the job market.
And he made an interesting point about inflation too, didn't he? That the threat hasn't just vanished.
Exactly. He argued that the effects of tariffs might take time to actually show up in the inflation numbers, partly because companies might have pulled inventories forward, stocked up before the duties hit.
Trying to get ahead of it. That makes sense.
Right. And Ryan Wang from HSBC, also quoted there, summed it up nicely, noting the double-sided risks tariffs pose. They could boost inflation, but they could also slow growth if they disrupt things too much.
So the core insight here, really, is that despite some okay economic data points, this overwhelming policy uncertainty, mainly from trade, is effectively keeping the Fed on the sidelines.
They're in a wait-and-see time period, as MarketWatch can it. That uncertainty is just a major driver of the near-term outlook.
And the next potential flashpoint for this trade uncertainty is just around the corner, right?
Yeah.
A 90-day pause.
Yeah, exactly. Remember that pause on many tariffs? It's set to expire on July 9th. Some are already calling it Liberation Day 2.0.
Liberation Day 2.0.
And the Yahoo Finance article, the Trump administration is offering 3 different scenarios. Lays out the possibilities the administration is apparently floating.
What are those scenarios looking like?
Well, they're reportedly presenting 3 potential paths to trading partners. 1, they might extend the pause for some countries. 2, negotiate specific trade deals with others. Or 3, just dictate unilateral tariff rates.
So it could be a mix.
The prediction offered in the article is that the actual outcome on July 9th could be a potluck mix, some extensions here, a few deals there, and dictated rates for everyone else.
A potluck. Great.
Yeah.
So even as we try to understand the current tariff landscape, the next phase of uncertainty is already looming large.
Precisely. It's a major piece in the Fed's puzzle, and it's not getting solved this week.
Okay. Now let's shift gears from policy uncertainty to geopolitical risk, which really erupted over the weekend and is definitely moving markets this morning. We're talking about the escalating tensions between Israel and Iran. Multiple sources covering this: CNBC, Bloomberg, MarketWatch.
That's correct. Reports from all the sources confirm a significant exchange of strikes between the two nations over the weekend and carry into Monday.
What were the targets?
Israel reportedly targeted energy infrastructure inside Iran, including facilities near the South Pars gas field, a major gas field, and an oil depot near Tehran.
And Iran responded.
Yes, Iranian missiles were reported to have damaged a refinery in Haifa, Israel. So direct hits on energy-related assets on both sides.
And the market reaction was pretty immediate, wasn't it? Especially Friday and then Sunday night.
Oh, absolutely. The fear of supply disruption given those targets sent energy prices surging. CNBC reported U.S. crude prices were up 3.7% and Brent crude jumped almost 5%, 4.94% just on Sunday evening as markets opened.
Wow. And gold, too. Safe haven.
Yep. Gold rallied sharply. MarketWatch noted it hit a fresh record high on Friday. Classic flight to safety.
And that wasn't just gold. Stocks globally took a hit on Friday, right? Dow, S&P, NASDAQ, all down significantly.
They were. And the U.S. dollar strengthened as well. That's another common pattern in times of heightened uncertainty. Money flows into the dollar.
Right, the dollar smile effect. But what's interesting, and noted in, I think, the Bloomberg article, futures rise, oil erases gains, and the CNBC Daily Open, is the shift we saw Monday morning. Markets seem to stabilize.
Yeah, find their footing almost, showing surprising resilience maybe. U.S. futures were pointing higher, and both Asian and European markets actually climbed overnight.
So what happened? Dip buying.
Seems like it. There appeared to be some dip buying happening, with investors perhaps taking the view, at least for now, that the conflict, while serious, isn't likely to immediately broaden out and draw in more parties. That was a point suggested in the Bloomberg article.
And oil prices, did they stay up?
No, and this is key for the markets right now. Oil prices actually erased those initial Sunday evening gains and were trading lower on Monday morning.
Why the reversal?
It seems to be a reaction to reports suggesting that critical export infrastructure, like major shipping lanes, wasn't significantly damaged by the strikes. That calmed nerves a bit.
And gold and the dollar pulled back slightly, too.
Yeah, they eased off their peaks Monday morning as that initial panic subsided somewhat.
But the elephant in the room for oil prices, highlighted in both CNBC and MarketWatch, remains the Strait of Hormuz. That's the big worry.
It absolutely is. There are reports that Iran is considering options, potentially interfering with or even attempting to close the strait.
And remind us how critical that is.
It's hugely critical. Roughly 1/5, 20% of the world's total oil supply flows through that narrow waterway, and about 20% of global LNG liquefied natural gas as well.
Could they actually close it?
Well, analysts quoted by CNBC expressed skepticism about Iran's ability to completely shut it down, mainly because the U.S. Fifth Fleet is right there. But they acknowledge the significant risks. Things like targeting individual tankers or using mines in the strait. That could severely disrupt supply and easily push oil prices above $100 a barrel. That risk hasn't disappeared.
No, definitely not.
No.
And beyond oil, this geopolitical uncertainty is also hitting Treasury yields, right?
Yeah.
MarketWatch and Bloomberg reported yields rising Friday and staying higher Monday. What's the link?
Well, there are a couple of factors cited. First, there's the fear of resurgent inflation. If oil prices spike because of this conflict and you add that to the ongoing trade policy uncertainty, well, that could reignite inflationary pressures.
Okay, inflation fears. What else?
Second, there are these persistent concerns about the sheer size of the U.S. government debt load and the rising cost of servicing that debt, especially with interest rates where they are. These factors make holding longer-term U.S. government bonds less attractive, so investors demand higher yields.
Which brings us to that quote from George Catrombone at DWS Americas in the MarketWatch piece. Gold, not the dollar or treasuries. He made that provocative statement.
Yeah, gold is the new risk-free asset in investors' minds. He was contrasting it with treasuries, suggesting that treasuries are now increasingly viewed through the lens of U.S. debt and deficit concerns, not just as a pure safe haven anymore.
That's a pretty stark view.
It is, and analysts in the Bloomberg article, Treasury Sell-Off, seem to echo this. They suggested selling pressure on treasuries is likely to linger if these geopolitical tensions persist.
Why? What's the connection they see?
They argued this kind of uncertainty could lead to increased global military spending, which is inflationary, and contribute to sticky inflation overall. Both of those factors would tend to push bond yields higher.
So geopolitical sparks, after that initial safety dash, now seem to be feeding into worries about inflation and debt, keeping pressure on bond yields.
That seems to be the market interpretation playing out right now, yes. A complex reaction.
Okay, let's zoom out for a quick global market snapshot from Monday, June 16th. Pulling mainly from CNBC sources like Asia stock markets today, European markets rebound, and the CNBC Daily Open. After Friday's drop, Asia-Pacific markets mostly bounced back.
That's right. Markets across Asia-Pacific generally climbed. They were also digesting some fresh economic data out of China. Retail sales there jumped 6.4% year-on-year in May, which actually beat analyst estimates.
So, better than expected. And industrial output.
That grew 5.8%. Top performers in the region included Japan's Nikkei 225 and South Korea's Kospi, both gaining over 1%.
And Europe seemed to follow suit, a rebound there too.
Yes, European markets also showed a rebound. The main Stoxx 600 index was higher, led by sectors like banks and, interestingly, oil stocks, probably benefiting from that earlier spike in crude prices we talked about.
Right, even though oil pulled back later.
Exactly. The overall move suggested a slight easing of that intense safe haven flight we saw late last week.
We also saw a few specific company headlines pop up in the sources. In Japan, for instance, shares of Advantest. They make semiconductor testing gear, right?
That's them. Their shares surged over 9.6%, making it a top performer on the Nikkei. Strong day for them.
But then in India, we saw Tata Motors shares plunge over 5%. What happened there?
That came after its subsidiary, Jaguar Land Rover, slashed its earnings forecast. And the reason they gave. They specifically cited uncertainty over the potential impact of U.S. tariffs on the auto sector.
Ah, there it is again. A direct link between that policy uncertainty we discussed earlier and a major global company's outlook. Really brings it home, doesn't it?
That certainly does. A very tangible impact.
Meanwhile, in Europe, shares of France's Renault dove over 6%. Any reason given?
That followed an announcement that its CEO would be stepping down, so leadership uncertainty hitting the stock there.
And looking ahead to the Paris Air Show this week, the big aerospace event, Airbus is expecting quieter orders.
Yeah, the CEO of Airbus is reportedly expecting more muted order numbers compared to last year's show. Partly attributed to rising defense concerns globally, maybe shifting priorities, and also, sadly, the impact of that recent Air India crash involving a Boeing Dreamliner. Though they stressed overall industry momentum still seems strong.
Okay. And finally, one more notable item. Taiwan adding Huawei and SMIC to a blacklist.
Yes, Taiwan's trade authority added those two major Chinese tech firms, Huawei and the chipmaker SMIC, to its strategic high-tech commodities entity list.
Which basically means
It effectively blacklists them for Taiwanese companies, restricting trade and tech transfer. And as the CNBC Daily Open pointed out, it further aligns Taiwan's tech policy with that of the United States, a significant geopolitical economic move.
so mixed bag globally, but those big themes, policy, geopolitics, they keep popping up everywhere.
They really do. They're interconnected.
Okay, let's pivot now to Policy Watch, focusing specifically on tax policy changes or potential changes in the UK and the US. Starting with the UK, this CNBC article, "Is the UK going to see tax hikes?" paints a pretty clear picture.
It does. The consensus among economists cited in that piece is that tax hikes in the UK's upcoming autumn budget are looking increasingly inevitable.
Increasingly inevitable, even though the Shadow Chancellor, Rachel Reeves, had pledged not to have another tax raid.
Exactly. Despite those past pledges, the fiscal reality seems to be pushing them in that direction.
What's driving that inevitability? What's the core problem?
The primary issue is the government's shrinking fiscal headroom. That's basically the amount of wiggle room they have before hitting their own budget rules.
Right, the wiggle room.
And that headroom is being squeezed by several factors. Higher debt interest payments, remember we talked about rising bond yields? Same issue affects the UK's borrowing costs. Also, weaker than expected tax receipts coming in and lower economic growth forecasts.
Lower growth forecasts.
From who? From the OBR, the UK's Independent Office for Budget Responsibility. They're now expecting growth of only 1% in 2025 and 1.9% in 2026. Plus, UK GDP actually shrank back in April, partly blamed on, guess what, trade tariffs and previous tax rises.
So it's a perfect storm almost. They have commitments to boost public spending, they want to fund day-to-day stuff without borrowing more, but the money just isn't coming in as expected and the economy's sputtering a bit.
That sounds like a classic bind, doesn't it? And the economists quoted basically see tax increases as the most viable, maybe the only real option left to close that gap and meet their own fiscal targets.
Does the article mention where these hikes might land? Any specific ideas?
Yeah, analysts are speculating on a few options. Things like extending the current freeze on income tax allowances and thresholds.
Which pulls more people into higher tax brackets over time, right?
For-
Fiscal drag.
Exactly. They're also looking at restricting pension tax relief for higher earners, maybe introducing a new levy on the gambling industry, and possibly a shakeup of the local property tax system known as council tax.
Interesting times ahead for UK taxpayers, it seems. Okay, let's move across the pond to the US. This MarketWatch article, GOP megabill, looks set to end the $600 tax reporting rule. Definitely caught my eye. This is about that new, lower tax reporting threshold for payments on platforms like PayPal, Venmo. That's the one. A provision within that large megabill package that recently passed the House of Representatives looks set to completely get rid of the $600 tax reporting threshold.
Get rid of it entirely.
Yes. If this bill becomes law, it would push the requirement for those platforms to issue a 1099-K form back to the old standard. Only triggered if a user had over $20,000 in payments and more than 200 transactions in a year.
So a complete rollback of the rule that came out of the Democrats' 2021 American Rescue Plan.
Exactly. That $600 rule was intended to capture more income earned in the burgeoning gig economy. It was expected to raise significant tax revenue.
But it faced a lot of pushback, didn't it? It really did. Critics slammed it for being overly burdensome and confusing, especially for individuals just using these platforms for casual things, selling old furniture online, getting reimbursed by friends for dinner, not running an actual business.
Right, the casual user problem.
And the IRS itself had already acknowledged the difficulties. They delayed implementing the $600 rule and set temporary higher thresholds, $5,000 for 2024, $2,500 for 2025, before it was supposed to finally hit $600 in 2026. Now this bill aims to just scrap it altogether.
And the article presents the different reactions to this proposed change.
It does. On one side, you have lobbying groups like the Coalition for 1099-K Fairness, which includes companies like PayPal basically celebrating. They argue the lower threshold created unnecessary confusion and compliance costs for everyone involved.
So they see it as reducing red tape.
Pretty much. But there's another perspective presented too.
Which is?
Caroline Bruckner, a professor at American University who studies the gig economy, is quoted. She argues that while this specific $600 rule might be going away, the fundamental issue of accurately taxing income earned outside traditional W-2 jobs isn't disappearing.
Because the gig economy is just too big now.
Precisely. She states quite pointedly that number is just too big to ignore. Her view is that Congress will inevitably have to revisit this challenge of how to fairly and effectively capture that income in the tax system eventually.
So the immediate controversy over the $600 rule seems likely to be resolved, but the bigger question of taxing gig work effectively, that remains very much open.
Exactly. And importantly, as you mentioned, this bill still needs to get through the Republican-controlled Senate. It's passed the House, but it's not law yet.
Right. A key hurdle still remains. Okay, finally, let's dedicate a brief corner to cryptocurrency developments. So there was this Bloomberg article, Bitcoin buyer Metaplanet is now bigger than chipmaker Kioxia. That headline alone is something.
It is quite a headline, isn't it? Metaplanet, which was, primarily a hotelier in Japan, has explicitly pivoted. They're becoming a Bitcoin buyer, kind of like the MicroStrategy model we see here in the U.S.
And then their stock has reacted.
Reacted is putting it mildly. Their shares have seen an absolutely explosive surge, climbed nearly 400% in less than 2 months, just riding this global crypto rally. And their market cap actually overtook Kioxia, which is a major memory chip maker.
400%. That's incredible growth. And they're planning to buy even more Bitcoin.
Yes, the article mentions they plan to raise another $5.4 billion specifically for further Bitcoin purchases. They're really doubling down on this new corporate strategy.
But it sounds like not everyone is convinced this surge is, well, sustainable.
You're right to pick up on that. The Bloomberg article points out a significant cautionary signal. Short positions against Metaplanet have grown substantially. They've reached about 23% of its free float.
23% short interest. That's high.
It is. It makes it the most shorted stock among Tokyo-listed companies of a similar size that don't have any analyst coverage. So it suggests considerable skepticism from some market participants about whether its current valuation is justified or if it's maybe gotten ahead of itself.
A sign of caution, for sure. And speaking of skepticism about crypto, there was also this MarketWatch opinion piece. Opinion. 3 reasons that Bitcoin in your 401k is still a terrible idea. This seems particularly relevant now.
Yes, especially after the U.S. Labor Department recently rescinded some previous guidance that had discouraged including crypto options in 401k retirement plans. This piece pushes back hard against that.
What are the main arguments it makes against Bitcoin in 401ks?
It lays out several points. First, it argues that participants, average retirement savers, often fundamentally don't understand what they're investing in when it comes to Bitcoin. It's complex and different.
Okay, lack of understanding. What else?
Second, it characterizes Bitcoin as a highly volatile, speculative investment. It explicitly frames it as being more like gambling than a traditional productive asset, because its value depends purely on someone else paying more for it later, rather than generating income or cash flow like a stock or bond might.
And it pushes back on the idea that this kind of alternative investment is necessary for better returns.
Yes, the author cites studies looking at sophisticated professional pension plans that have shifted more into alternatives like private equity. The piece notes these shifts haven't necessarily translated into higher after-fee returns compared to simple, low-cost index funds.
Implying that complexity doesn't always pay off for the average investor.
That's the implication. The argument is that adding complex, volatile assets like Bitcoin doesn't guarantee better retirement outcomes and might even harm them due to volatility and fees.
And the final point was about prudence, right? Fiduciary duty.
Exactly. The piece argues strongly that including Bitcoin in 401k is likely not a prudent move for the people managing those plans. It highlights the fact that most big, professional, defined benefit pension plans managed by experienced trustees do not invest in Bitcoin.
And the logic is, if the pros aren't doing it,
then why should it be offered to 401k participants who are generally considered less sophisticated investors than those professional trustees? The author concludes by saying the Labor Department's job should be to protect retirement savers, not open the door to what they see as overly risky and speculative activity.
So a very clear and forceful argument against crypto in retirement plans, based on that source's perspective. Something for listeners to definitely think about.
Definitely a viewpoint to consider as this debate continues.
So as we wrap up this deep dive into today's financial headlines, we've really navigated a landscape defined by these interwoven uncertainties, haven't we? We looked at the Federal Reserve, trying to maintain this delicate balance, some okay data signals, but really held back by the massive unpredictable factor of tariff uncertainty, especially with that July 9th deadline looming.
And we saw how rapidly escalating geopolitical tensions in the Middle East can trigger those immediate market reactions, flights to safety, surging oil prices impacting bond yields, even as markets then try to find some sort of resilience amidst those very real risks.
Plus, we touched on specific developments globally. China's data giving Asia a bit of a lift, but then company-specific news like Jaguar Land Rover's earnings getting hit directly by tariff fears, and those policy shifts, potential tax hikes coming in the UK, and that expected rollback of the $600 tax reporting rule here in the US.
It really underscores the message from analysts, doesn't it? That investors are heading into this week, which includes that important Fed meeting, with just a significant cloud of uncertainty hanging over pretty much everything.
Which leaves us with this thought for you to mull over as the week unfolds. Given this complex web connecting things like trade tariffs, oil prices driven by geopolitical events, and central bank policy decisions, consider how an unexpected development in just one of these areas could trigger significant, maybe unforeseen, shifts in the others.
The ripple effects.
Exactly. Thinking about the details we pulled from today's sources, which seemingly small piece of information, perhaps buried in one of those headlines about tariffs or oil infrastructure or even tax policy, might turn out to be the most important indicator to watch for those potential ripple effects.
It's a good reminder of just how interconnected everything is in the global economy right now. Lots of moving parts.
Something to keep an eye on for sure. Thanks for joining us for this deep dive.
Always a pleasure. Thanks for having me.
We'll see you all tomorrow morning with new headlines from major financial magazines.